The Great American Tear explains hidden economic divide nobody notices. Why you are losing a race you never knew existed. The Hook begins with a strange schizophrenic economic reality. News anchors glowing while claiming inflation is completely dead now. They proudly say your paycheck is finally starting to grow. GDP rising fast while job markets appear incredibly strong. Stock market hitting all-time highs almost every single week. It starts feeling like a repeated meme across financial media. Then you pause and look directly at your own life. You check your bank account and feel something is off. You notice rising prices of eggs, cars, and housing. Suddenly, it feels like you exist in a different reality. You begin questioning your sanity and your personal financial decisions, wondering if something is fundamentally wrong with your situation. But the truth is far darker than simple confusion. You are not crazy. You are unknowingly being held hostage. For the first time in nearly 100 years, the United States is operating two separate economies simultaneously. One visible economy and one hidden beneath the surface. If you follow traditional advice of working hard, saving money, you are trapped inside a system rigged before your birth. The game was designed long before you entered it. Today we break down the hidden playbook controlling outcomes. We reveal who created the rules behind this system, why even earning $400,000 yearly cannot save you. The one key difference between winners and losers today. Part 1 begins with the lie rooted in 1929. To understand your struggle, we must travel far back, not to recent crises, but to the Roaring '20s era. Back then, the economy looked just as unstoppable as today. The Dow Jones increased 6 times within 8 years. Unemployment rates dropped below 4%, creating massive optimism. It was a nationwide celebration fueled by endless confidence, but beneath the surface, cracks were rapidly forming everywhere. Farmers drowning under heavy debt, unable to recover financially. Factories producing goods that ordinary people could not afford. Just like today, people borrowed money to buy stocks, believing only fools could lose money during booming markets. Then, suddenly, the crash of 1929 arrived. The Great Depression erased 85% of market value. Entire fortunes disappeared within an incredibly short time frame. But here is the detail rarely taught in schools. By 1933, the stock market began recovering strongly. It surged over 300%, shocking many observers. Wealthy investors celebrated victories across Wall Street floors. Meanwhile, ordinary citizens suffered deeply on Main Street. Americans stood in bread lines, struggling to survive daily. Recovery did not trickle down to the general population. If it trickled at all, it took many years. That moment created a separation between market and economy. Today, we are witnessing a dangerous reunion of both, the stock market reaching highs while confidence hits lows. Consumer sentiment dropping even during apparent economic success because markets do not measure the reality of your life. They measure how much profit wealthy investors can extract. Part 2 explores the addiction driving this entire system. Like all addictions, it started small and seemed harmless initially. Before 2008, the Federal Reserve remained relatively stable. Only $800 billion circulated in the system. Then the housing crash forced drastic and unprecedented actions. Interest rates dropped to zero almost overnight across markets. Massive money printing began to stabilize failing financial institutions. Trillions of dollars injected directly into financial markets. This policy became known as quantitative easing globally. But the simple truth behind it is very clear. Money was pumped directly into the stock market engine. By 2014, $800 billion became $4.5 trillion. By 2020, it doubled again, reaching $9 trillion. Here comes the critical catch most people never realize. That money never reached your personal bank account directly. Instead, it flowed into assets owned by wealthy individuals. Stocks surged upward while real estate prices skyrocketed rapidly. Those who already owned assets became significantly richer. Those without assets faced rising living costs and inflation. Rent increased, groceries became expensive. Daily life grew harder. A powerful feedback loop was quietly created by policy. When economy slows, money printing resumes once again. That money flows upward, concentrating wealth among the rich. The wealthy spend, boosting GDP numbers artificially higher. Politicians celebrate positive metrics without addressing root problems. Then the system becomes incapable of stopping itself. Attempts to reduce printing trigger immediate market crashes. For example, when tightening happened around 2017, markets reacted negatively, forcing reversal of those decisions. The system became addicted to cheap and endless money. Like any drug, the required dose keeps increasing. Each cycle demands more stimulus to achieve similar effects. Part 3 reveals the conspiracy of 3 powerful players. Addictions exist because someone profits from selling the product. 3 groups actively maintain and benefit from this system. Player 1 is the corporate chief executive officer. Companies like Lowe's spent billions buying back their stock. $46 billion used for stock buybacks recently. That equals roughly $28,000 per employee. Average worker salaries remained just above $30,000. Nearly equal spending on stock boosts versus worker pay. Reason lies in compensation tied heavily to stock options. Executives must increase stock price to maximize personal income. Player 2 includes massive asset management corporations. Firms like BlackRock, Vanguard, and State Street dominate ownership. They collectively control 88% of major index. These firms vote on executive compensation and policies. Their profits depend on total assets under management. Rising stock prices directly increase their earnings significantly. Therefore, they rarely oppose stock buyback strategies. Conflict of interest exists on an enormous visible scale. Player 3 consists of influential political figures. Politicians accumulate massive wealth while holding public office. Many outperform markets through well-timed strategic trades. Over 100 lawmakers actively trade regulated company stocks. Presidents frequently highlight stock market success as achievement. Regardless of political party, market performance remains central talking point. This creates a closed loop of shared incentives. Leaders need markets high to secure re-election success. CEOs need markets high for bonuses and compensation. Asset managers need markets high to maximize fee income. Breaking this cycle is portrayed as harming ordinary pensions. In reality, the system protects itself above all else. Within this structure, you function more like a hostage. Part 4 explains the K-shaped economic split clearly. This divide becomes visible during everyday life situations. The economy splits into 2 dramatically different directions. One side rises upward while the other declines. The middle ground that once existed is disappearing. Consider fast food chains like McDonald's as example. Originally built for affordability, serving working-class families. Recently, low-income customer traffic dropped nearly 10%. Majority of Americans now view fast food as a luxury. Meanwhile, higher-income customers increased their visits significantly. Similar patterns appear across retail and hospitality industries. Luxury hotels raise prices due to overwhelming demand. Budget motels reduce prices because customers stopped coming. Economist Mark Zandi analyzed spending patterns across income levels. Bottom 80% barely keep up with inflation rates. Their spending power remains stagnant with no real growth. They are effectively running in place financially every year. top 10% show dramatically different spending behavior. They continue spending aggressively, driving majority of economic growth. Half of GDP growth comes from this small group. This creates a distorted perception of economic strength overall. Headlines celebrate growth driven by wealthy consumption patterns. Reality for majority remains financial pressure and instability. If you belong to bottom 80% group, life feels like running on an accelerating treadmill daily. Meanwhile, the middle class continues shrinking over decades, from 61% in 1971 down to 51% in modern times. Most individuals are not moving upward economically anymore. Instead, many are gradually sliding downward into instability. Final section reveals the only realistic way out. The solution challenges common beliefs about income and success. The dividing line is not how much you earn. The real difference lies in what you actually own. High-income professionals often struggle despite large salaries. Expensive lifestyles consume earnings without building lasting wealth. Meanwhile, lower-income individuals can achieve financial independence by purchasing assets early and holding them long-term. Even those earning over $500,000 feel trapped. Many report living paycheck to paycheck despite high income because they participate without owning the underlying system. The structure directs wealth toward asset owners consistently. When money is printed, asset prices rise automatically. When companies buy back shares, prices increase again. Inflation further pushes asset values higher over time. Those without ownership continue falling further behind economically. The only escape is shifting position within this system. You must move from being inside water to boat. This does not require becoming an active day trader, but holding only cash guarantees losing purchasing power. Savings erode silently due to ongoing inflation pressures. Owning assets provides exposure to upward economic forces. You need a stake in the side that rises. This principle is not political ideology, but simple mathematics. Understanding system mechanics determines long-term financial outcomes. Ignoring reality ensures continued disadvantage within the system. The situation may feel like a hostage crisis, but opportunity still exists for those willing to act.